Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen. If you guys are joining us for the first time, Will and I, we do this show in the mornings to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you have a question, you could come on the show and ask your question live. We provide a link to Zoom on that live chat on YouTube. If you click on it, it takes you over to Zoom. There's a button at the bottom of the screen that says raise your hand. Click on that. It'll ask you if you want to turn on your video camera. You don't have to. Once we let you in, you could ask your question live and direct. If you prefer to type in your question, you could type in that question also on that live chat on YouTube. Will's watching it. He's reading it. He'll read it back to me. And while we're waiting for questions to come in or more people to come in, what we'll start doing is taking a look at the pre-market report. And these are stocks trading in pre-market hours. See if we could get some insights from that. And so, Will, let me know if you have questions. I'm going to start it with the pre-market report. We'll get to those. So the pre-market report, these are our stocks trading in pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 211 stocks made our percentage gainers list, 45 on the decliners list. So right now, from this perspective, we're lining up for a more bullish bias at the open. If you look at this list, you'll see that there are stocks in there that are low cap stocks. We have ETFs on the list, leverage products, closed-end funds, preferreds, anything that's listed on the major U.S. exchanges that's trading in pre-market hours and it meets our thresholds, it can make this list. So what we want to do is narrow down this list to a smaller group of stocks to see if we could get a more focused insight. And to do that, we could use the filters up here. And I'm going to use this one in ETF and drop it down. And you see that there are a list of ETFs to choose from. The top three, those are the broad-based ETFs. And let's choose this one, SPY. That's the S&P 500 ETF. And when you select it like this, you will see that the list below will get filtered by stocks that are holdings in SPY, which are the S&P 500 constituents. And here we have 36 stocks that are made our percentage gainers list, 300 decliners. Again, from this perspective, right now we're lining up for a more bullish bias at the open. And of course, we had the CPI number come out. And that looked like it was either a little bit better or in line with expectations. And it's shown that although we still have an elevated rate of inflation, I think, what was it, like 5%, Will?
Yeah, which actually looks like it's forecast at 5.6. I actually used our new economic calendar to kind of do a work through to find it. It was really quick. Okay. It's nice.
So better than expected. And I guess what they call this is disinflation, where while it is increasing year over year, it's coming down, right? So we're not increasing at the same rate, we're increasing at a slower rate, and they're trying to get that down to 2%. And maybe some of those actions that they took are making it head that way. Something here, I know I see Tesla up here made the list up 2.1%. Besides, the reaction in the overall market, I think they are moving to make certain rules around emissions more aggressive in the, I guess, in the attempt or effort to push people to buy more electric vehicles, opting out of the traditional, gas vehicle. I think it's still something like 93% of all vehicle purchases are still like the traditional, gas powered. And they want to, I think, start pushing people more towards the electrical vehicles. So they are planning to change some of those rules, it sounds like, which can be benefit the EV market. So that's been kind of circling around, in the news lately, something to pay attention to. But I think what they're attempting to do is actually make the gas vehicles more expensive, right? They're going to be more expensive, so then the electrical vehicles can compete on price with the gas vehicles. And you still have the issue people preferred, I think, because you travel longer distances, right? On a gas vehicle, I think you're still traveling.
Yeah, I mean, there's lots of people own gas vehicles. Lots of people take long. I mean, this holiday weekend, I knew people who drove as far away as Florida for 5 days. Right? People get in the car and go.
Right.
There's also the ram of getting all these batteries made is a boom for lots of places on Earth. None of them are in the U.S. right now. Right? Most of that's rare earths come from Africa or China, and the batteries are made. It's an interesting dynamic.
No, definitely. Trying to get people to move over to the EV market, even though it seems like a lot of it's booming still. The vast majority of car purchases are not in the EV space.
Yeah, and buying a Tesla is not. Well, no car is inexpensive, right? But you look at a Tesla, and it's if you don't love the car, which I know we have fans of MarketChameleon who love Teslas. It's a very expensive purchase. You've got to.
You're shelling out a lot more than for an electrical vehicle. I think it's what was that? It was a big gap. I think the median price was 23,000 versus like 64,000 for an EV. So there's a big gap between the median price for an EV and a gas vehicle right now, and they're trying to close that out. Even with the tax incentives, you still have a big gap between them.
And when if everyone all of us, if you snapped your finger and everyone had an EV, well, how's the network of electrical lines, power stations, how's the whole grid going to hold up?
That's
not good. It's not. We don't have the generating capacity for that. So I hope they have a plan for that piece of the puzzle.
So another thing here to pay attention, there are going to be some FOMC speakers today. So we got like at least 3 here on our list. And those will be important because people are going to be asking questions and, trying to get some insights. Okay, we got the CPI number out today. That looked better. What are they thinking as far as interest rate policy goes? And, so far they've been basically indicating, look, they're going to raise one more time. And I don't think that today's CPI number is going to change that because we're still well above their 2% target. We're at 5%, 2% target. We're still far away from there. They indicated they're going to raise a quarter next month and hold it there for an extended period of time until they see inflation going down to their target 2% and staying there, right? My interpretation of it is, as long as if it gets down to 2% and stays there, there's really, no reason for them to bring it down unless it goes below the 2%, because they don't want to create the inflation again, right? They want 2%, there, and they want to see that consistently at 2%. So it's not like you hit the target, and all of a sudden we're back to, interest rate policy, 0%, flooding the economy with money. But we'll hear from them what they're thinking. It's good to, important to listen to them for clues, what their expectations are, because they're the ones that really make the decisions on those Fed funds rate. Couple things also, that on the inflation front is that we're still, when we're talking about disinflation, we're starting to see those things ticking up, right? Especially asset prices across the board, equity prices, commodity prices, gold, silver, oil prices are starting to tick back up. Housing is doing, but here's the housing. Let's see the housing market. That's starting to come back up. So we could reaccelerate, and the trend could just reverse. How do you keep it going down to the 2%? So you could see here, mortgage applications increased 5.3% from 1 week earlier. So there you have it. People are out there, applying for mortgages, buying homes. And again, that could, if that continues, we'd see pricing pressure again in the housing markets. So something to keep an eye on. I don't think it's like a straightforward answer that we're going to keep declining.
Well, I mean, look at, you just mentioned the government change in laws and rules relative to combustion engines. What's that going to do to the price of vehicles, right? I mean, that's going to be inflationary. It's not going to be deflationary.
Yeah, exactly. Those will be inflationary pressures on the car manufacturers for sure. I mean, that's what the car manufacturers themselves are saying. And I think that's the intent anyway. The intent is to make it more expensive to make the choice between EV and a regular car, more competitive.
Yeah, they'll both be really expensive. That's going to be awesome.
Right. Exactly. So let's take a look. If there are no questions, I'm just going to navigate to SPY real quick.
Sounds good. I did, if you go back to that calendar, one interesting thing, and I don't know if you saw it, but if you follow through the link for the speakers, you can actually, there's a link to watch it live, which is interesting.
Oh, you're saying when they start speaking?
Yeah, they have you can watch the discussion live.
Yeah, so this will take you to the source, and as you can see, if they post a live video there, you could just go. That's straight from the Federal Reserve's website.
Yeah, very cool.
Yeah, I'm sure it's going to be, other major news organizations are going to be, summarizing whatever they say.
Yeah, well, a couple years ago, this would have been, wouldn't even been discussed really, and now it's, a huge issue affecting every piece of the marketplace.
Yeah. Let me come back to the SPY. And one of the things, I don't think you guys have access to this right now. But, one of the things, you want to, well, let me see how I can describe it. So with the SPY, there's no one way to price an asset. You try to estimate the price of the value of an asset compared to the price, and try to benchmark it to see, how far away is it from a historical benchmark? Is it at a large premium or a large discount? And when you're doing financial modeling, right? Any financial, there's no exact answer. It's estimates. You could see here, we were just discussing about the CPI and the Federal Reserve trying to get it in line and doing the right things and tools, and they're looking at data and tweaking things. Well, that's how financial markets work. We're not working with exacts, because what is the price of SPY? We could get maybe an exact NAV, right? So we can take a look at what the stocks are inside SPY. We could take the weightings, and then we could calculate the net asset value of each unit and compare it to the price. That would be an easy exercise. And if there's a big discrepancy, it would create an arbitrage opportunity. And those are basically already arbed away. So then when we look at the price of a stock, right? What is the price of the stock telling us, right? That's the price is actually a forecaster, right? It's forecasting something into the future. It's a predictor, right? It's telling us that people are willing to pay a certain amount today because of some expectation of future earnings, right? So when we look at a stock price, we have to determine, well, how are we gonna try to figure out, is this fair value, is it underpriced or overpriced? And the thing with stocks, when you're trying to, you have to take it down to the major factors that go into a stock price. Okay. And when you create a model or financial pricing model, it could get complicated. You get tweaks, and obviously there are many variables that could go into it. But you want to start out with, if you're starting out with a simple model, what are the major variables, right? What is the major variables that will impact the value or the price of this stock? And when we look at stocks, they're going to be, it's different than something like a painting or a rare, or a diamond or something, because a stock isn't some tangible asset that you're going to put on your wall and enjoy, or wear it around your finger, or a Rolex watch. That's not what a stock is. So you can't price it that way because it's rare and it looks good on you, or it looks good on your wall. And it's not exactly priced the same way as a house either, because even a house, a property has a utility. It's tangible. You could live in it. You could enjoy it. So if there's a certain amount of available houses, in a particular area, in a beach town or whatever, the price of it could just reflect, the desire, the demand to live there, right? But stocks are different, and what are the major variables people invest in the stock is because it's an investment. They put away, instead of consuming the money, they make an investment with the hope that, sometime in the future, they'll be able to get more money out of it than they put in. And what drives that is earnings, right? So earnings are one of the biggest factors in pricing a stock. And stop me if you have questions or people want to move on.
Cool.
So if we could see what SPY, we could see the most recent earnings, right? We could see if we took all the companies in S&P 500 and we added up all their earnings, we know what they earned in the last year or 10 years or 5 years. That we see because that already happened. What we don't know is what's going to happen in the future. That's going to be a guess, right? So the first thing we want to look at is, okay, based on just last year's earnings, right? Based on last year's earnings, what are we paying for this stock? And I like to look at it as yield, like when you guys look at a cap rate, let's say if you're buying a piece of real estate, you buy a house and you rent it out, and let's say you bought it for $100,000, you collected $10,000 in rent, you paid $5,000 in taxes and fees and mortgages, you have $5,000 left over. So your yield on the, let's say no mortgage, forget about the mortgage. You bought it $100,000 cash, collected $10,000 in rent. You had to pay taxes. You have to pay certain, maintenance, all this. Let's say you got $5,000 left over. Well, you're earning 5% on that investment, right? You put in 100,000, you're getting 5,000 back from your rent every year. So you're yielding 5%. And that's kind of like, okay, that's my starting point, right? So this would be equivalent to over here. This is what we're going to call is the operating yield. So there are different ways to look at earnings, right? I usually look at the operating yield because those are profits that are coming from your main business. Okay, so that's not including like if you sell Tesla cars, it's looking at profits from selling Tesla cars. It's going to exclude if you made some investments out there on buildings, you bought a building, sold a building, if you bought crypto and sold crypto, if it's not part of your major business, that will be excluded from there. So here we could see at least based on the trailing 12 months, and what people are paying today. This is the yield that you're looking at trailing 12 months. Okay. And this is important because one, now you could start comparing the yield, this yield, to what other assets are yielding, right? You could look at junk bonds, you could look at, AAA rated bonds, double B bonds, or the treasury. So the first thing you want to look at is, well, is this beating the risk-free rate? Right? Because if I could earn more in the risk-free rate, the treasury bonds, then I got a real choice to make here. Why am I taking this risk? Because, earnings are very volatile. They could be up or down really big. So that's an important metric to look at, because any financial asset you're going to look at, any financial model that I know of, no matter if it's bonds or equities or options, the risk-free rate is always an input into the model, because that's what you're benchmarking again. Well, where's the risk-free rate? So here we have the treasuries here. I kind of like to look at the 5-year instead of the 10-year. And compare to that, but it's subjective. There's no right answer. A lot of people look at the 10-year, and or some even look at the very short term. So why I picked the 5-year is the following: that when we price stocks, right? When we price stocks, it's not just the trailing 12 months, but there's a growth factor. And the growth factor is, well, what do I think the earnings will be going forward, right? And the expectation is, history shows over a longer period of time, earnings grows. But the problem is with earnings is that they're very, very volatile from quarter to quarter, from year to year. So to smooth it out, you have to look at the long-term trend line. That's why I use 5 years. Some people think it's 10 years out because they're so volatile. You look at a 10-year trend So I'll show you
Yeah.
here.
And what were great businesses in 10 years could become not as important, right?
Not as good. Yeah, exactly.
I
It's
I
very
just,
hard to do a 10-year. That's why I'm like sticking to the 5-year. And
I heard
anybody,
the other day that Tupperware was exploring, basically liquidation options, bankruptcy options. I mean, when I was growing up as a kid, the Tupperware product was everywhere, right? And
yeah,
now with, leach-in and all the other things that are going on with inexpensive products from overseas or whatever, their business has been literally destroyed, right? They can't sell their product and make money.
it is really hard to predict. Earnings projections are like one of the hardest things, that to get. They can't even predict the next quarter. How are you going to predict? If you look at quarter to quarter, how volatile they are. Like trying to do it 5 years. So what they do is you're smoothing it out. So at SPY, number one, you're smoothing it out because you're taking 500, companies, and instead of one. But even that is very volatile. So this here is a chart just to show you how volatile it is. This is a chart of 5-year annualized growth rate. So what is the average growth rate year over year over a 5-year period, right? And then we show this year over year. So you could see just how volatile, this is what this is trying to forecast. The earnings growth going out into the future. And, here it does look like, the trend line has been, around, what did I say, averages is saying like 6.4%. We dipped hard during COVID, and then we shot up after that stimulus, and it's coming back towards the trend line. So, obviously, it's impossible to predict earnings growth. I think it's completely impossible, but if we needed a benchmark, let's use the long-term trend line, right? And see how far away we are from the long-term trend line. So the idea is, all right, whatever the market's forecasting, let's use the long-term trend line and see how far above or below they're forecasting. Okay. So if we're right at the trend line, then our implied value will be close to here. If we're above the trend line, then the stock's overpriced. If we're below it, it's going to be underpriced. Okay. So people with me here?
Yep.
So here is we're right up at 9:30. If people like this, I could continue this tomorrow.
Yeah, let's do that. We'll continue to look at the valuations tomorrow. Awesome job, Dima. Okay. And remember, everyone, if you missed yesterday's IBKR webinar with D, it's on their website. I will put it in the link so everyone can go. We actually have a library on Interactive Brokers educational platform of over 25 webinars, which Dimitri was nice enough to do for the Interactive Broker audience and any chameleons who came over. I know the mayor was on yesterday. It's always good to see a friendly face when you have 150 people you've never met before, which is always interesting. But it was a great webinar yesterday and a great show today. Thanks, D.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace, chameleons. Bye.